So I actually think there are a lot of reasons to be bullish about growth in the U.S. Companies are now refocusing on efficiency and productivity rather than juicing up earnings through levered buybacks and, cheap financing costs. You tend to see investors willing to pay a higher multiple for companies that are actually focused on efficiency. And companies are now finally focused on efficiency, and they have new tools. They have AI, they have automation.
So that was Bank of America's securities analyst. She's very bullish on the market. How is she so bullish in the face of the macro forces, right? We got inflation going up, we got bond yields up. We have a lot of competing forces against that. So is automation enough? Is technology actually enough for the market to go higher, right? There's a lot of questions. Are we headed into a recession? Is inflation going to go back up? So let's take a look really quick, right? Let's take a look at the technicals. And today, what do we have? Today we had S&P sell off this morning. Okay, so let's dive into that really quick. Let's take a look here. S&P sold off in the morning, pretty strong, right? We're coming right back into that 444 level. We do the technicals, we do the macro, we do the fundamentals, and we got all that. Today, we also got the Fed's Beige Book, which is a projection of accumulation of all their economic conditions, right? All their commentary on what they think's going forward, all the regions. We're going to go over that too also. So we got a lot booked in. Stay tuned. We're going to go over that. So first, let's dive into the technicals, right? S&P sold off this morning from that 448 level. We came in at 444. What have we been saying? 444 is support. The question is, can we hold? This is the Jackson Hole level, the key level from Jackson Hole after the Fed meeting, right? The market started pricing things in and said, all right, you know what? The Fed's not as hawkish as we thought they might be. So we got above that level. So we're finding support there. We don't know if we're going to continue. We'll see. Taking a step back, looking at the trend, right? Looking at the trend, we're forming, we talked about this yesterday. We're sort of forming a wedge here. Okay. I think we're going to keep this wedge up until we get CPI, until we get the Fed's decision, and how I really think we wedge until the next Fed meeting. I think that's what it's looking like. Maybe some other stocks go off before that, right? But I think we're wedging. We're still in trend. We're still moving higher. But first, now let's go into the macro data, right? What we got today. Let's take a look at that. Yeah, let's take a look at the macro. So here's what we got going on. First off, okay, let's dive into that. There we go. Leaving the RRP. This was from yesterday. Come on, Twitter's messing up a little bit. A lot of information on here. All right, so what we have is, I'm just going to click on this. This is sort of like, that question is, why would investors, right, be investing if all these macro factors are negative? We see oil pumping right back up, right? And I've told you guys, oil is the biggest threat to the market, because if it holds above the 83.50 level, you get CPI starting to go higher. Now, that's going to be sticky. The positive there is, well, of course, still coming down, but oil also is a component to plastic, to deliveries, to different services, right? It's still an input. So that could spell something bad. We got the dollar moving up too. That's also not good. But this right here, right? This is the money leaving the Fed. I keep saying this, liquidity coming back in, and it looks one for one with the S&P, right? So as long as this cushion comes in, there's going to be liquidity coming into the market. And I know we're talking about the economy too, but that's why I think the market is staying up, because you're getting that liquidity come in. Sorry about this. Hold on. I'm getting a little frozen here on my, probably because I'm streaming. Come on. Sorry about that. All right, let's get into this. Here we go. So yeah, we'll keep talking here. We'll keep going here. So that's it, right? Now today, the data we got was the ISM services. Oh my goodness, this thing is not popping up correctly. Today with the ISM services pisses me off, man. We cannot play. Okay, yeah. So we're just getting some technical difficulties. Let's see if I could click on this. Okay, let's just click on it. So economic activity, right, and services. Today we pushed higher. We broke higher than expected. What are the ISM services? This is business activity. This is economic activity in the services sector, right? And the Fed talked about this even on the Beige Book. They want to see, they want to keep track of economic activity. Is it rising? Is it falling? Is it too high or is it too low? So services are still, and these are leading economic indicators. So these are still pointing to an expansion for the economy so far. And this takes in consideration business activity, new orders, employment, supplier deliveries, inventories, prices. But like this is the most forward-looking data, and it is a sentiment indicator. So you're asking supply chain managers, and it looks like services are starting to rebound, right? And that takes us to the next part. Hopefully, Twitter is not messing up on us. The next part here is just looking at the manufacturing and the services part of the economic activity. They're both starting to rise now. We're getting in red. That is the manufacturing part of economic activity, what the Fed is focused on, and the services, and they're both starting to rebound. So this is why it's like, hey, I don't think we're headed into recession, right? You hear it, oh, we're in a recession, we're not in recession, but these are forward-looking indicators, and they're telling us that businesses are actually saying, hey, we're picking back up here. We're actually starting to pick back up here on the supply side of things. Okay. And yeah, rates are a little higher, but there's a reason why certain businesses can actually get through this, right? You're going to get a recession in some areas. Now, after that came out, the ISM, it was a little hot. The ISM was a little hot. So now the probability of a hike actually did go up by 200ths. So not much. Yesterday it was at 7%, went up to 9%. So not much of a change there. Not seeing much of a change there. Okay. Yes, it's a little bearish that services came out hotter than expected because it is outside of, it's a surprise, but I don't think it's that bad. Now, so the question is 10-year rates, looking at rates here. Okay, are they going to be higher for longer? We're at 4.25, right? The 10-year rate is actually pushing. Now, one thing to keep in mind, the Fed funds rate is one thing, but the market does not borrow money off the Fed funds rate. Right, that's irrelevant. It is the bond market, it's the treasury market that really matters here, which is why when we see rates going up in the treasury market or bonds falling, that's a real risk, right? That is a real risk here, but maybe we just trade sideways. So is that possible for us to trade sideways and the market to go higher? That's in the question now. Or do these just keep surging? Do we keep going higher because we see oil prices climbing higher? Right? So we got to keep track of oil there. Now, here's the positive. Here's another positive here is that when you look at the S&P 500 earning calls, right? Most of this is kind of positive, kind of negative. You see most of those recession calls are happening in financials, right? So yes, these rates are affecting certain companies. I think we're in a rolling recession. And but you see on the downside, energy, communication services, consumer staples, you're not seeing too much recession talk on those calls. So I think the rolling recession continues, and when we do look at the the bank stocks, right, they're starting to struggle here because rates are squeezing them to some degree, right? Maybe the big banks, the too big to fail banks are okay, but the smaller regional banks are in trouble. So we're getting a rolling recession. But again, when you look at, and this is from FactSet, when you look at the amount, when you look at the whole S&P, you're seeing over the past year that recession calls are coming down. And we talked about this in the last earnings season, which was, hey, I think that earnings are going to recover here because looking at forward data or sentiment data, a lot of companies are just not talking about recession, right? That's coming back down to levels from 2019, really historical levels. It continues to fall when you talk about recession on an earnings call. Now, banks obviously are going to be talking about that a little more because we had that banking crisis, and they're still getting hit by the lag effects from the Fed, right? And we're going to get into the Beige Book here. So the Fed Beige Book, this came out today, which is basically their projections on the economy, and we're going to get through that. Nearly all districts indicate business expectations that wage growth will slow broadly in the year term. So wage growth is not a big issue, and that's just not what they're seeing. And there's different regions that we got to go over. Some districts highlight a report suggesting consumers may have exhausted their savings. So that's the bearish part, right? Have consumers actually exhausted their savings here? And there's also a lot of evidence. Everybody has this conflicting evidence right now, and it's kind of hard to, who do you stick with? Where do what are we looking at? Are savings coming down? Yes, the rate of savings, but is there still enough cash in the system, right? Are consumers going to roll over? A lot of conflicting data there. Now, 42 macro came out with some 42 macro came out with some stuff on Real Vision yesterday, and he was talking about why the economy is still resilient. Now, keep in mind, he's expecting a recession. Okay, this is Darius Dale. He's expecting a recession, just not in 2023, because there's a lot of supports on the economy. We're going to go through them here, and so maybe we see it in 2024, but then maybe the Fed, actually hikes. Actually cuts rates right in 2024. We don't know. So this is the reasons why the resilient economy continues despite all the factors that we are seeing, right? First, near record cash on household balance sheet. So you hear the opposite of this, and he says, "Hey, that's just bad data." There's near record cash on households. Why do people keep spending? Right. Also, think about it. Most people have locked in their rates at 2 and 3%. I think it's like 70% of households already locked in low rates in their household. So we're not really going to see that recession in housing. You will a little bit, but you're not going to see people collapse because they're not paying. Most people are not paying high rates. Period. That's just not the case. Near record cash on corporate balance sheets. What does this have to do with? Well, we talked about these. We had these charts out on the newsletter probably about 3 weeks ago, which showed that most S&P companies have locked in, 78% have locked in rates that were much lower before. Like, they're not dealing with the Fed funds rate, right? The Fed funds rate at 5.5%, they're not paying those rates. Most debt is being serviced at 2 to 3%. So in the corporate world, so they're not really doing. Now, maybe when they have to refi in, by 2030, I think most 50% was refi. 50% of S&P companies had to refi by 2030. So you have time before this actually hits corporations, right? And something could change in that between that time period, right? Private sector income and wealth have outpaced inflation through the business cycle. Okay. So really, wages, whatever it is, corporate earnings, they are outpacing actual inflation. Inflation has been coming down. The cost of capital has been going up, but producer prices went negative in the US. I believe we went negative for a little bit. They're rebounding a little bit, but the point is that there's still more cash flow being made versus where inflation actually is, right? Limited credit cycle vulnerabilities. We look at this all the time. We look at credit, right? We look at credit, we look at the move index, we look at volatility, we look at triple B spreads, and there's no credit vulnerabilities in the equity market, right? If people would be dumping equity debt, which is fixed income, they're using equities in S&P 500 companies' debt to get fixed income, right? They're yielding off that fixed income. Once they start dumping it, then we'll have some issues there. Limited exposure to the volatile manufacturing sector. Okay, well, who's most of the earnings in the S&P are coming from what? They're coming from big tech, right? They're coming from big tech and a lot of these big companies who are not exposed to the manufacturing sector. So all the recession, all the companies who are struggling, they're not contributing so much to the actual EPS of the S&P 500, right? Long variable lags. So yeah, those long lags are going to hit later. They're just not hitting right now. They may be hitting later, maybe 2024. It looks like 2023 is going to stay clear. We're looking at the ISM data. We're looking at the forward-looking economic data, and it is pointing to a recovery. It is pointing to a recovery. So some people argue we're at the end of the business cycle where we should be collapsing. Other people arguing, well, actually, we're at the beginning of the business cycle because the ISM manufacturing economic activity is actually turning up. So that's why we're going to turn to the Fed's Beige Book to actually see what's going on there. What up, Diggs BTW7? How you doing? So we're going to get through this report first, then we'll do Q&A. We're going to go over the technicals. Also, Zoom. A lot of people, a lot of interest in Zoom because the COVID fears are back, and maybe Zoom's one of those calls. Who knows? Perfect storm for new housing development. So yes, a lot of people are a lot of home builders. This is where really the housing market's not falling apart. A lot of home builders building multifamily homes. We talk about this all the time, and the home builder ETFs are at all-time highs, right? Because there's a lot of development from the infrastructure bill. The CHIPS Act also goes into that. All these things feed on each other. And if you're building a lot of apartments, guess what? There's no rates on those apartments. You're not paying as a renter. You're not paying higher rates. So there's more demand there. Bidenomics. Well, he says actually Bidenomics are going to run out at some point. I doubt it because I think there's more stimmy checks to come. If the consumer does slow, I do not man, it's really easy to start giving people checks again. Is that inflationary? Sure. We'll see where rates are at. We'll see where growth is at that point. But if growth is falling apart, if jobs are going negative, and then you get stimmy checks, well, it's not really inflationary unless the supply chains are broken, right? That was the issue during the pandemic. We had broken supply chains. That's not the case today. Immigration, right? Better immigration policies, better working, and then labor hoarding, a lot of labor hoarding. So those are the reasons why this economy continues to stay resilient, and we're in Goldilocks, where inflation is actually decelerating, right? You get deceleration in inflation, and you get the acceleration in growth. Or it's really hard to argue where growth is at, but growth is economically, the leading indicators are starting to bottom and pick up. Services has already been in expansion, and then when you take a look at housing, well, housing did bottom. It's slowing now, so growth is not falling apart there. And then, uh, also you have, let me see, the economic activity. Consumers are starting to slow a bit, but they're still spending, right? And then the jobs market is cooling, but people are coming into the labor force. So you're getting a lot of very balanced activity, really balanced, where it's not too hot, it's not too cold, and that sets you up for a strong stock market, especially when earnings are going up. We see earnings revisions actually starting to pick up. So that's a positive there, right? We're going to get to the Beige Book also. We will get to the Beige Book, but let's take a look at S&P bouncing off that 444 level. Does it hold? Maybe not. But when we look at the macro forces, right? 2-year yields starting to climb back up. That's a negative, right? That's a headwind for the market. 10-year, 5-year, 30-year. We're looking at all these rates. 30-year is not as strong, but a lot of rates are moving up. TLT cannot find a bid. It did, and then it sold right back off, right? The dollar still breaking out headwind to the equity market. This is a headwind, but there are times when you can have strength in the dollar. And here's what part of the reason the dollar is strengthening. China has to print, right? Some economies are starting to ease and loosen and cut rates. And when they cut rates and when they start printing, it strengthens the dollar automatically. So this isn't necessarily a risk off move for the dollar. This isn't really, when it does go up, it is risk off, but it's not like coming from the economy. There's no credit risk or anything. That's not the reason for the rise. It's simply because other currencies are propping up the dollar by debasing themselves, if that makes sense, right? That's why you're getting dollar strength, which is why I still don't like the dollar to go up, but the dollar's not going to really come down until the Fed pauses, until the Fed starts to cut rates, or they start to print again and start debasing the dollar. That's not the case right now, right? You go to oil. Oil is a negative force. Why? Because CPI is moving higher. And we talked about this yesterday. CPI is probably going to be stickier now on the headline if this continues. And it looks like it's continue, right? It looks like it's going to continue, and we're going to be in a stock pickers market. That's what it sounds like. We'll be in a stock pickers market. I expect the Qs to outperform because as inflation expectations go up, and the question is, well, yields will go up, right? Things start to tighten. It's going to come down to who can actually generate revenue, can generate margins in a slow growth environment with higher rates. It is still possible because of automation, because of AI, right? Which we're about to use in a second here. That's why. And you look at the VIX. There's no real spike in the VIX. There's no worries. I think the only thing that gets the VIX up is a black swan event. Will China invade Taiwan? Very low probability. Now you see the COVID fears. Well, that would shut down the economy. That would bring inflation to zero, right? The next pandemic. I really doubt it personally. I don't see the VIX would be spiking if that was the case. But hey, who knows? Going forward. So bond volatility still suppressed. There's no real risk in the bonds, and we see triple B spreads, which are credit risks, are not rising. So that's just not the case for the S&P. Looking at the Qs, right? How are the Qs finding support? The Qs going to be up. The Qs are at support, 372, 373. That is the support for the Qs, for tech. And I think tech will start to outperform here, right? Dow is starting to fizzle out. Well, it's in the trend, but I think because the Dow's a lot of value stocks and they're going to struggle with higher rates. They don't necessarily have high margins to still generate cash flows, right? IWM, I expect that to actually be weak until rates come down. Why? Because these are companies who just haven't made an earnings yet. They're still not profitable, and higher rates just threaten the business model in general, which is why, again, big tech is going to be okay because they have so much cash, right? They have so much pricing power in general, and you might see the Magnificent Seven continue. There's so much spending in AI happening that cash will slosh around and make for a strong bull market. So we're going to dive in the Beige Book in a second here. LeBron's cousin puts or calls, no way. another stock live. Let's see. Okay, don't see anything there. Right. So we're gonna jump in the beige book, and this is basically what the Fed is saying, right? This is gonna be what the Fed is actually saying, and we'll go through that. And the reason I said I use technology, because I threw this into actually threw this into Chat GPT. Hopefully this is working here. I think I let my computer. Oh, my computer is recovering. Okay, there we go. So this is the beige book. Oh no, not that one. This is the Fed's beige book, right? And what it is basically taking all of their commentary and trying to see, okay, where's the Fed stand on the economy? This gives you insight on to whether they are going to hike or not, or what the path is, even looking into September, even looking into not September, I'm sorry, November, December, January. That gives us all of that, all of that. So here I got it on the website, right? Didn't send it out yet. I'm going to send this out in a second if you want to look. So this is, I put this into Chat GPT and it just spit out what we should be looking for. This is what the Fed is looking at. And by the way, the market did bounce as soon as the Fed's beige book came out. The market bounced higher. Okay, the market did bounce higher, and a lot of that was algorithms. But I think because there's more of a dovish outlook going forward. So let's go through this, right? The overall prepare. We're about to read here and translate. I'm going to translate to you what this means. So this is overall. So economic growth, as far as economic growth, the overall growth was modest in July. Okay, we know that modest growth. Consumer spending, tourism. There's stronger than expected uptick in tourism, likely due to pent-up demand for the pandemic. So we've had spending. We know we've had consumer spending. I think a lot of that is coming from the baby boomers, right? The older generation, or the gig economy. Those who are still, they're not getting fired, but they're making money from social media. They're traveling. If you notice, you watch videos, hey, a lot of those people are still traveling. So the gig economy and the baby boomers are still spending. They're still, they're still moving. They're going, they're spending money, right? Retail spending. I think this is slowing. Retail spending, particularly on non-essential items, continue to decline. Yes, people are not so this is the consumer actually deleveraging themselves. They're not spending as much. This is positive. They're not spending much on non-essential items. So they're cutting their spending in areas that are non-necessary. So that might hurt certain companies, but if you're a Magnificent Seven company, it doesn't really matter, right? The slowdown might be attributed to some consumers having depleted their savings, and we saw that savings rate come down, now relying on more borrowing, which is credit card usage, which borrowing is spending, which still fuels the economy. And we saw consumer spending is leading the global economy right now. Auto sales. While new auto sales increased in many districts, it was more due to better inventory availability than heightened consumer demand. So better inventory availability basically meaning there's so much inventory, they had to cut prices, right? We saw Tesla leading with that. Tesla is cutting prices at an insane rate, and they're going to take market share during this uncertainty, because who's going to pay higher gas prices? Who wants to do that? Pay higher rates for a car, right? When you can get a Tesla, they're cutting prices significantly. The Model Y at the beginning of the year, Model S was 100,000. Now it's like 79, 74,000. So there's certain companies, there's a bull market somewhere. And I think that's going to be in Tesla. We're going to go over the technicals in that also going forward. Manufacturing, supply chain delays have improved, allowing for manufacturers to better fulfill orders. So there's no supply chain pressures, right? This is supply side inflation. It is dissipating. There's progress there. This is good. New orders, these were either stable or shown decline across most districts, leading to shorter backlog. So again, less clogging in the supply chain. This is part of the reason that we have such high inflation. This is disappearing, which is why, again, I say even though gas goes higher, oil goes higher, well, we're not going to see a big spike of inflation. Maybe we get up to 3.7 headline, 3.8. Now I'm revising and saying, okay, this oil is breaking out, but hey, we don't have any supply chain issues. That's not the case yet. Housing. All right, single family housing. This is an issue for the Fed. Supply remains constrained on the single family housing side. Yes, it does. Not on the multifamily, which caused surge in new construction activity. So there is a lot of new construction activity, which is why the housing market is starting to ease, and prices, I believe, are going to continue to trickle down for real estate. A lot of people are going to be underwater here that already own it, and there's going to be an opportunity probably in real estate, but even more so, prices should be coming down. Affordable housing, the construction of affordable housing was impeded by factors like increased financial costs and rising insurance premiums. Okay, let's go to banking. This is where I think the recession is happening. Loan demand experiences varied across districts. However, there was a general increase in consumer loan balances. Some districts also saw a rise in delinquencies on consumer credit lines. So, yeah, there's gonna be some roughness. Take a look. Keep your eyes on the regional banking stocks. What is the? Let me quickly look. It is going to be regional banks. The ETF is KRE, right? KRE. If you guys are familiar, keep an eye on KRE. We saw the S&P is reporting the weakest earnings or the most recession calls in the banking sector. So hey, that's fine. It slows down a bit. Agriculture, the sector has mixed conditions. However, there was a widespread reports of drought and escalating input costs. This is an issue because if you have droughts, the supply chains and input costs go up. Well, this has to do with food, right? This has a lot to do with food and consumption. You want more productivity, not less. So that's a red flag there if that continues. Energy, the energy sector remained mostly static during the summer months. So what does this mean? Well, I mean, during the peak demand of energy, we didn't actually get a whole lot of demand. This is why OPEC is cutting. This is why you're seeing the Saudis cut, not because, oh my God, there's a big demand. No, they're cutting because demand is falling. So this is not a systemic issue for inflation. What it is controlled supply being taken offline. Okay. Well, other producers are actually increasing their supply. So I don't think this really lasts. Maybe oil goes to 95. I have to up it, right? I have to change my stance on that because we broke out of that level. So that is the case that maybe we're higher for longer. Maybe rates are higher. Maybe the dollar's up. Maybe the stock market consolidates sideways for the next 2 months. Who knows? And maybe you get those mega cap tech companies who have margins, who have a good balance sheet, who can still earn in a high rate environment, they probably go higher. That's my guess as we start leading, the big tech starts leading, right? Those ones using automation, AI start to lead. So overall, economic landscape seems to be a mixed bag while there are indications of recovery in sectors like tourism, manufacturing. So there's a recovery. Like they're actually saying there's a recovery in manufacturing. And what did we get? The ISM PMI survey starting to recover. New orders are picking up. Employment is coming up in services. So parts of the economy that were in recession are now starting to recover. This is good news. Others like retail spending, affordability, housing, construction face challenges. So there you go. Recovery in tourism, manufacturing, and now you're getting retail spending on certain goods and items actually start to decline. So rolling recession. The continued strain on the housing market combined with increased resilience on consumer borrowing suggests some underlying economic vulnerabilities need to be addressed. So the Fed needs to address this, or at least fiscal policy will be addressing this. Now moving to the labor market. So we just finished with economic activity that calls for the Fed to pause. There's nothing strong about that for the Fed to start hiking there. Now, labor market, right? This is about wage growth. This is about the labor market. And are we going to get wage inflation, right? So jobs growth. Overall jobs were muted across the nation. This suggests while the economy might be recovering or stabilizing in some aspects, it hasn't translated to robust increase in employment opportunities. So the jobs market is cooling. Basically, it is recovering in some areas, but it's still cooling. It's basically a nothing burger, right? Jobs growth is declining on a year-over-year basis. We see that. But labor participation, which we're going to get to, is picking up. So that's a positive there so far. Okay, labor market imbalance, right? This is more technical, but just stick with me here. This means no wage inflation. Even with slowed hiring, there was still a mismatch in the labor market. Many districts reported a shortage of skilled workers. Hey, here comes AI, and a limited number of job applicants. Not a whole lot of people applying. This imbalance can lead to increased competition among employers to attract and retain skilled talent. So they're actually saying, hey, this might be a wage price spiral, even though that's not really what their words are. I think they're just flagging, hey, this is a possibility. Potentially pushing wages higher or leading to enhanced job benefits. So if you don't get enough people coming in, basically employers have to raise their wages. But we do have AI, right? We have artificial intelligence. I just saw the other day. There was a video. You can find it at a coffee shop. They were using AI to track the productivity of skilled workers. So there you take care of certain management, and I think it's going to be a nothing burger. The labor market is coming into balance. We see the labor market participation rate is back to pre-pandemic high. So the data is contrary to this. I think they're just, making sure that this is an important thing to keep looking at going forward. Worker retention. Retention seemed to be improved in specific sectors like manufacturing and transportation, so they're not losing workers there. This could be due to several factors: better wages, improved working conditions. We know, we know the what is it? We've seen like with UPS, we've seen a lot of deals being made to enhance those conditions, really just give people incentives to keep working. The inherent stability of these industries compared with others during the current economic climate. So you're getting wages go up in some areas, but at the same time, participation is picking up. And the last data we saw, which is average hourly earnings, those ticked lower. That is Goldilocks. Wage inflation is not happening, but you are getting better retention. Okay. Wage growth expectations. So here are the expectations for wage growth slash inflation. The statement, the second half of the year will be different, implies a belief amongst businesses that the trajectory of wage growth will change. Okay, nothing there. The growth in the labor cost pressures was higher than anticipated in the first half of the year. This suggests that businesses might have had to offer higher wages to attract and retain employees. And remember, this is also going all the way back for the last quarter. This does not factor in, a lot of this does not factor in the recent data we just got. However, it is seemingly paradoxical twist. Businesses across nearly all districts anticipate the wage growth will decelerate soon. So they're stating, hey, actually, it's actually going lower, right? And that's what we're seeing actually happen with the numbers, average hourly earnings, with labor participation, job openings coming back down. And companies not having to do that. This could mean that businesses expect the labor market imbalances to correct themselves, and people are coming in because they're seeing recession, right? They're seeing a lot of layoffs happen, so they're coming back in. We saw the unemployment rate tick up. That balances out the labor market. Technology advancements, look at that. This is very important right here. Correct themselves. Other factors like technological advancements, right? AI, artificial intelligence, automation is going to help this. You don't need to increase wages when you can use automation. Tesla's using this in their factories to help build cars, right? Offshore outsourcing, I guess that's still happening. Offshore outsourcing, this will suppress wage growth, so that's positive. Summary, we still have blah blah blah. I think we just went through suggest caution, optimism. It's pretty much they're just saying we got to watch out. There's no definitive answer. Now prices, right? This is where everybody's worried at. Is the Fed going to hike because of these prices, price growth? Overall, the growth rate of prices seems to have decelerated across most districts. Okay, this is a growth rate of prices. That's good. The growth rate has decelerated, right? That is disinflation right there. It's not deflation yet, disinflation. The slowdown in price growth was especially prominent in the manufacturing and consumer goods sector. Okay, you're getting a deceleration in goods and manufacturing where everything boomed during the pandemic, right? The complete opposite here because people are spending in services. So you're not getting inflation in that area. This could be due to various reasons, such as improved supply chains, exactly, better supply chains, lower demand. Yes, payrolls are lower, GDP is lower, China is struggling, and other market dynamics. So price growth is expected to keep decelerating, right? Insurance costs, maybe these actually went up, who knows? A notable exception to the general trend of decelerating price growth was the significant increase in property insurance costs in several districts. So insurance went up. Damn those guys. This reason could be I'm not even going to try to say that. Malfeasance, including increased risks like natural disasters due to climate change. Oh my God, here comes the politics. They're trying to blow up houses to get the insurance up. Who knows? Higher claim frequencies or adjusted to previous underpricing. So that's just nature. You can't change that, right? You've had tornadoes. It's not nothing too unexpected. You get these on a year-to-year basis here in Phoenix. I think we've hit the highest heat wave, or we've had the highest heat over 100 days of over 100, something like that. We're breaking records with heat, and then there's natural disasters happening. There's floods happening over there in Nevada, right? So a lot of crazy stuff happening. Input versus selling prices. Even though input price growth decelerated, so these are the input costs which lead inflation, it did so at a slower pace than selling prices. This implies that the cost businesses are incurring, the raw materials and labor are not decreasing as fast as the prices they were able to charge customers. Okay, so basically some input costs are not falling as fast as the Fed would like it to, right? So hey, if you're in, like I said, if you're in automation, you're in tech, you're benefiting, your input costs are going down. Tesla, I'm always referring to Tesla because I know their business a little better. Tesla prices to create batteries is decelerating. This is partly why they can lower prices for customers. So that's different, which is this points to a lot of companies are going to struggle because their input costs have bottomed, but the ones who can automate and use technology, they're actually they're going lower, so they can increase their margins, which is why it's a stock pickers market at this point. Businesses seem to be finding it challenging to pass on these cost pressures to consumers unless you're big tech. This can be due to a variety of reasons, such as competitive market dynamics, consumer price sensitivity, and look at all your subscriptions from your big company, Apple subscriptions, Google, YouTube subscriptions, right? YouTube Premium, or was it Netflix? They all went up because they can pass their prices over versus other companies just can't do that. They got to eat those prices. Their earnings go down, they don't survive, right? So this really balancing out who can survive in these higher rate, moderately higher inflation environment. So it's going to be a stock pickers market. I think that's what we all come back to. That's what the beginning of the video was. The Bank of America analyst said, hey, efficiencies are actually creating opportunities for investors to go after those companies who can actually create more efficiency instead of just use free money to buy back shares, because they take over market share. They become more monopolistic. So profit margins, given the dynamics between input and selling prices, it's not surprising that the profit margins have reportedly shrunk in several districts. When businesses can't fully pass on increased costs to consumers, their profit margins get squeezed, except for the technology companies, right? Exactly. This is why, again, you're going to see big tech continue to outperform because they can pass over those prices. They can increase their prices and do just fine. Now, I did throw in ChatGPT some of the districts. This will be really quick. These are just some of the districts. Everyone's a little different. What they're saying in Boston, modest business expansion. Boston's expanding a little bit. Used car scarcity persist. Well, there's not enough cars. Hey, let's get some Teslas over there. Decline in home sales in Boston. Reduced concern about imminent recession. Most people are not worried. Mixed bag. Boston is fine. New York, steady economic activity, solid labor market with consistent wage growth. Okay, that's great. Manufacturing is declining in New York. Home sales constrained by low inventory, rising mortgage rates. Well, they're screwed, right? In New York, the prices are just way too high. Mild inflationary uptick. So New York, maybe Boston's doing better. Philly, right? These are all the districts for the Fed. Slightly decline in business activity. Okay, so whoa, theirs is going down. Who wants to live in Philadelphia, right? Consumer spending in non-manufacturing activities fell. Improvements in labor availability and employment. So it looks like Philadelphia is having sort of a recession here, right? The district of Philadelphia, subsiding wage growth and inflation. So they're easing though. The positive is yes, they're looking at recession, but also the prices are coming down. New York's prices are probably not coming down. They're pretty even. Boston looks pretty solid actually. Going over to Cleveland, flat economic activity with industrial specific fluctuations, whatever. Reduced consumer spending. Okay, they're slowing down. Stabilized freight activity. Their manufacturing is picking up. Richmond, slight economic growth. Consumer spending in retail, food services, tourism improved. Wow. Okay, so Virginia, people are actually spending and people are visiting. Okay, so that's interesting, right? You're getting consumer spending slow down in other areas, but not this one, right? Rolling recession. Decreased in manufacturing demand. All right. So this is the opposite of New York, I believe it was that we went over, or Boston. This is the complete opposite, rolling recession. Residential real estate limited by inventory, same inventory issues. Apartment rents are going to go up. Atlanta, modest economic growth, improved labor markets, robust retail sales. Atlanta's fine, right? Their economy is totally fine. Chicago, slight economic increase, moderate employment growth, stagnant construction and retail sales. They're pretty steady, nothing too crazy. St. Louis, steady economic conditions, tight labor market, struggles with price increases. So St. Louis could be struggling. It looks like they might have to do higher wages, and they may be seeing some inflation there. Minneapolis, slight growth in economic activity, consistent employment growth. Okay, increase in consumer spending. So Minneapolis might be fine. And these are a lot of these cities. It's like, well, if they have a nice city, it seems like they're going to be okay. Stable economic activity. Well, the policies make a big deal too. The fiscal policies are going to be a big deal. So this is good, right? You want to see who's doing better. What are their economic policies or politics? Who's actually handling this? Which governors are able to implement policies that are going to help with this inflationary environment. So this is going to be important, especially for Tesla, because you want to open up that energy grid, blah, blah, blah. I bet you Dallas is doing well, right? Kansas City improved manufacturing services due to better supply chains. I haven't even read this yet. So maybe my guess is Dallas is doing okay because this is Texas and they have a lot of energy. They're fine. Continued modest expansion, not too hot, not too cold. Mixed sector activity with non-financial services growth. Okay. So Non-financial services growth. Okay, good. You don't want financials have been growing a lot. Um, so I guess no services growth there. Elevated price pressures in services. Okay, that's not good. So Dallas, mixed bag, same thing, rolling recession. San Francisco, slight economic strengthening. Okay. I think that's the first time we've seen that word happen. Improved labor market availability. Okay, that's good. Persistent, though slowing price increases. Wow, San Francisco looks solid. Localized impacts from wildfires and severe weather. So San Francisco looks well, probably because they have Tesla there. No, I'm just kidding. So yeah, that is the economic projections there for all. This is the Fed's beige book. This is what the market was a little bit concerned with. So we'll get back to the price action here. This is what the market was concerned with, right? And I think when we put it all together, what it shows us is that the Fed doesn't need a hike. The Fed can hold right now. Hey, given that oil doesn't keep spiking, but remember this next inflation reading has to do with the last month's of inflation, which I think is going to come out flat. My expectation 3.3 to 3.2. I think we're flat here. Maybe we do go higher, but the beige book is telling us that the economy is in a rolling recession and that it should it should balance itself out going forward, right? And you have pockets of strength, pockets of weakness, and this is not even adding in automation and AI. Once you get that in the bag, you're going to get a takeoff, a lift off in certain S&P companies, and others are going to really struggle here. So I think that's the case going forward. You look at crypto. You talk about crypto blockchain, people don't understand, is going to bring price stability, efficiencies to the financial system, right? To banking, into finances, into trade, into costs for settlement, right? That is the case. That's why BlackRock is advocating for this Bitcoin ETF and for the tokenization of pretty much all securities, because it brings efficiencies, it brings down those costs. One of the biggest inflationary spikes in this last CPI report from the Fed's PCE was financial services, right? Other than transportation services, which we know went up because what? Because oil went up, duh, right? But why are financial services going up? That should not be the case, right? In a slow economic environment where inflation's high, why the hell is Wall Street? Why are these banks charging more, right? That's not fair. Whatever. Talk about fair, they can do it, right? So crypto lowers that bar. Crypto makes it more efficient, the right cryptos. So that is the case. You get the Bitcoin ETF and you're pretty much gone from there, right? So getting back to the market, right? Getting back to the market here. And we'll talk about what we should be seeing tomorrow. We have let me see, what is the S&P doing? Oh, let's look at sectors, right? How are these sectors responding to this? I bet you energy's still up. So you get financials up. I'm gonna go through this really quickly. Financials up. KRE. Oh, we talked about this. The banking sector is rolling over. Okay, what this is gonna do as the banking sector rolls over, okay, this is important here. If KRE really starts to break here, let's do the TA, technical analysis, really quick. This is these are regional banks. Well, here's the problem, right? Regional banks are going to suffer when bond yields go higher. So as bond yields go up, the what's happening really in the yields going up is the collateral, the actual bond. You can look at TLT is falling. Well, regional banks hold a lot of treasuries, and they're already struggling because their treasuries are falling, their collateral is falling. They already had a banking crisis before. People left a lot of deposit weakness, which is why which is why we're getting pre-earnings calls to you're getting warnings for a recession in the banking sector. So I think that is signaling that we're going to get a really deep fall in KRE. Now, the last time we saw this, what was the Fed's response? See if I can find not Fed funds. What is it? It's Wallclave. There you go. Fed's balance sheet. So see, I memorize some of these dang indicators. So what happened last time KRE fell? KRE collapsed because of the banking crisis, because rates were too high, and they're higher now. They're pretty much higher now than they were before. So KRE collapsed. So even though oil is going up, the dollar is going up, yields are up. Well, if these yields tighten too much, what it's going to cause is a crisis where the Fed has to unleash more liquidity into the market. That's usually what happens, right? What's happening with China? The exact same thing. Their property market falls apart. Now their stocks are surging. Today, Evergrande had the biggest upside move it's had in history. Why? Because everybody who held it in the past got crushed. and new liquidity came in. They're cutting rates for housing to improve the housing market. They're increasing liquidity um, into their central bank is injecting liquidity, right? If you keep up with my channel, we talk about China all the time, second biggest economy, very important. So what's going to happen when our regional banks roll over again? And this is what this highlight was. It was, when are they going to roll over? Now we're getting the rollover, right? The technicals tell us what? The technicals tell us that there's a fundamental change in the ownership of these ETFs, right? There's literally less buying happening. We're starting to roll over. And if that is the case, the Fed should pump liquidity. Here's yellow. That is the Fed pumping liquidity. Okay. So that's KRE. Just wanted to point that out. XLE going higher, right? Well, higher energy, right? Higher energy prices. Guess what? Also that translates to better equity earnings, right? Better earnings for energy stocks, which also props up S&P 500. Now this is going to be interesting. Solar, I think they maybe catches a bid. This is solar energy ETF. Maybe they catch a bid in the fourth quarter. I keep saying that because of the Inflation Reduction Act coming online. Clean energy, same thing. But hey, these are going to be huge opportunities. Eventually, they're going to explode, right? They will explode eventually, just not now. XLK, right? This is tech. We've already went through the Qs, pretty strong. SMH, still trending up. So you're still getting the semiconductor. This will probably break out at some point. It just went up too fast, right? Consumer communications. Hey, if the COVID hits, look for communication sector to really, I don't want to call it COVID. I don't know what they're calling it right now, but the pandemic, right? They got the politics, the media is trying to do right now. If it is real, then I expect some of these communication services to pick up because there's going to be a big bid to keep efficiencies and using AI to keep the supply chains or to keep business going. And we've already been through this. It's not a big surprise. So if, let's say, things do start to shut down, well, a lot of these companies are going to receive a lot of demand, right? These communication services. I like Zoom. I think it's probably the best. Has a really good balance sheet. Here we go. Industrials are pretty much stuck here at this point. Healthcare still, wow. Healthcare is I think next to tech is the biggest part of the S&P. So that's weakening. That's very interesting. I didn't expect this to happen. Biotech still really risky, high rates. Biotech isn't that great. Most biotech companies are not profitable. Consumer discretionary, right? Here's where this might outperform you. Can the consumers keep spending? Basically, can they keep spending on bigger ticket items? And these are probably people who have money more so because they still, most of taxes that are paid by the top, I think it's like 90% of taxes still come from 1% or something like that. So, are they going to keep spending? Basically, is the question. Consumer staples falling apart. Nobody wants defensive stocks. We're going in. It's not a real recession yet. And then retail rolling over. We expect that. We saw the consumer spending reports in retail are slow. They're muted, right? Utilities just getting destroyed. Nobody cares because I think there's risk on the table. Builders catching a bit, a little bit. Real estate muted. Home builders catching a bit, a little bit. We'll see how this continues. Probably being led by consumer staples there. All right, so we went through a lot of information. Q&A. Let's do some Q&A. And I'm going to look through some information. You got any questions? Right, we can do Q&A. And if you got any questions, any charts you want me, any technicals you want me to go over, let me know. That is the macro report that I usually do, right? What's hitting the tape, right? What is the market trying to digest today? What is volatility doing, right? Is the VIX spiking? Not really. Had a little spike. What is the macroeconomic data? What is the Fed actually saying? What are the technicals to the market? Which sectors are actually moving versus others? Who's going to benefit from the potential risks or benefits here? And that's what we do here on the channel. Coin and Riot. What's up with Coin and Riot? SPY. You want to look at SPY? So SPY, really simple. We look at SPY all the time. If you want to see the charts that are on YouTube, go subscribe. If you want to help me out, I'd appreciate it. Go sub at YouTube, trying to grow my YouTube. And that would be good support for me if you guys don't mind. So S&P, right? Chugging higher. We're above. And then we'll do a Tesla, Coin, Riot. Yeah, we'll look at that. So S&P 500. Now, here's one thing that's very, very important, right? Other than the technicals is, we'll look at that chart afterwards. Either way, so looking at the technicals, big support at 444, right? Keep in mind. Now, let me zoom in here so that people can see this. Zoom, Zoom stock. Hey, Josh Brown buying Zoom. Zoom starting to move up. All right, so before we had the Fed symposium, which was Jackson Hole, right? The market is always predicting, they're positioning themselves, they're looking for expectations. Before that, the market got stuck at 444 right here, right? After Jackson Hole, after the meeting, what did Tom Lee say? Typically, 6 out of 7 times the market goes higher following the symposium. Well, that actually carried through, right? So we got higher. I said, hey, if we do retrace, which we probably will, the market moved it quick, it'd be 444. Now we have this nice wick, which is a sign of buying pressure at that level, which is a sign that bears are covering and a sign that bulls are stepping in at 444. So we're seeing that support being formed at 444, almost to the dot, right? So 444 is the support. Now, if something shaky comes out, because I think we're in a wedge, that could drop. That could drop. It could definitely drop. But just given the pattern, but markets don't move off patterns. It moves off what's coming next, right? And we're going to go over what we might see next. So 444 is that pattern. Are we still above the 50-day moving average is the question. We're right on it, right? So now we're struggling on that 50-day moving average, 446-ish. Okay, if we can't get above it, we probably do trade back down to 438 is my guess, just giving the path right now. It's not super bearish. What it is the market's trying to decide how to trade itself. And it's just a trading, right? It's trading right now. There's a lot of algos. As soon as the services PMI came out hotter than expected, which I did literally flag this on my Twitter. Go check out my Twitter. I said, this is what I do. If you guys want to check out the Twitter, see if I could do this quickly so it doesn't stall the stream. But I did point out on Twitter earlier that day, which there's some other S&P stuff on here we got to get to. This was last night. And I said, hey, ISM services come out. The Fed is focused on economic activity, right? We get this on Wednesday, economic services activity. And they're expecting 52.5, whatever. Not too cold, not too hot is what the market wants to see. Anything above 53, neutral to bearish, because it triggers the Fed. It triggers the Fed. And what did we get? We got 54. So this came in pretty, I'm not trading this, day trading this, but it's just my response. It's just neutral to bearish. And what do we see right now in the price action? Are we getting neutral to bearish? Let's check in. Oops, wrong. Neutral to bearish. So what do we get today? We got, you could call it, let's go to the 5-minute chart. Early on, we got bearish, right? Bearish. And now we're looking kind of neutral. Now, are we going to finish off strong? I don't know. Are we above, below VWAP? Where's VWAP at? I can't see VWAP because I'm not on my traders. Anchored VWAP. Let's do anchored VWAP from the open. Okay, we're struggling at VWAP, right? This is where the institutions will buy or sell at. So we're struggling there. Maybe we don't, it looks kind of bearish. We'll see. Either way, we came into the level, right? Neutral to bearish. Well, it turned out to be more bearish than not, but we did bounce at the big level. It's not extremely bearish. Why? Because if your services are expanding stronger than expected, that further pushes out the recession fears, which a lot of people are betting on a recession, right? They're betting on a recession, so they have to change their net. Oh my goodness, services are strengthening. That's not the case. That's why I think it's neutral to bearish. And it's just a lucky guess, I guess. Anyways, that's S&P, right? We're at that 50-day moving average. We need to get, it looks like we're not going to hold it. We'll see. We'll probably get in power hour, which is coming up, right? We're nearing power hour right now. Maybe I'll throw on the trading stuff to see how we finish off. Now, the big important point here for the Fed or for the S&P, okay, in general, is this reverse repo liquidity that I pointed out at the very beginning of the stream. Where did it go? Don't tell me it disappeared. Come on, load up. Reverse repo liquidity. Oh, there it is. Okay. So reverse repo, what is this? This is the money. This is the cushion that we said this about 2 years ago. I said, hey, if this money ever leaves the Fed, so just as a understanding, this money went up, right, during the inflation wars, right? As soon as inflation spiked, well, all this cash left this is before the Fed started tightening, by the way. This money left risk assets. I'm telling you, this is all about risk assets. Tesla, Bitcoin. I don't want to say Bitcoin yet in crypto because there's a little different catalyst, but risk assets in general, right? This was leaving risk assets because Cathie Wood's ARK Invest literally peaked in March of 2021. And all of a sudden, all this cash started flooding into the reverse repo at the Fed, right? It peaked here in December of 2022, where ARK starts to outperform, where the market actually starts to outperform. And so now this cash is leaving, you can see very clearly the cash is leaving the reverse repo. And where is it headed? It's either headed to the treasury market to support rates, which is not happening right now, or it's headed into risk assets. Now, the reason I flag this is cash, right? This is coming into some markets. Who knows where it is? I think it's going to chase the best of the best, the Teslas, the Apples, the Nvidias, the AMDs. I think that's who's going to chase, because they can still perform in this low rate environment. Now, here's what I usually do with this. I invert it so you can see literally how similar, how correlated the S&P is, right? Let me take these moving averages off. How correlated the S&P is with the reverse repo cash. How correlated is that, right? That's pretty, I want to call it 1 for 1. So you get the consolidation, boom, moves higher. So this reverse repo cash leaving the Fed, coming into capital markets, is my signal that if this continues, and I'm just keeping track of it, it's not exactly 1 for 1, but you can see the trend over a month or two period is pretty similar. It's pointing higher. So I think S&P, there's a lot of cash coming in, and it's going to come find these stocks like Tesla, Nvidia, Apple, Amazon, right? Those who can retain their margins, who have a strong balance sheet, who are gaining market share, who have innovation, who can outperform interest rates, who can outperform an inflationary environment, who are becoming a monopoly at what they do, and pushing the gig economy forward. So I think that's the case. That's what we're going to keep seeing there. And so keep that in mind. And I'm always going to show that update so you guys know that's where I think the liquidity is coming from for the most part. So we got that. Now we're looking at Coin and Riot. Okay, Coin. The Coin and Riot, I'm going to tell you right now, it's very simple. Either rates, the only way this goes up is if, now this does look like a reverse head and shoulder, so it looks really good, but when the narrative is so strong, it really doesn't matter. So yeah, you got a nice reverse head and shoulders there. I know there's another shoulder, but basically the break over 100 is going to be very bullish for Coinbase. But what you got to understand here is, now if you're day trading this, that's different, right? They had a nice bump and it came back down. But if you're looking for the macro move here, like the big move, the confirmation, you got to get above 100. It's going to come with the ETF. It's going to come with the ETF, right? And they all depend on, the whole crypto market right now is dependent on the potential liquidity coming in from the ETF. You open up hedge funds, you open up retirement funds. We're talking trillions, tens of trillions of dollars. Doesn't mean all that money comes in. It just means you're opening it up, and just a percentage of it is going to push the price much higher. It's going to cause shorts to cover. It's going to cause breakout traders to come in. It's going to cause long-term holders or hodlers to buy more, right? So this is going to be a huge catalyst, probably the biggest inflow in crypto that we've ever seen, in my view. So Coin and Riot are going to depend on that. And by the way, what did we get today, right? Talk about crypto. We had a filing from ARK. I have this on my Twitter. So if you always want to see the information I'm talking about, just follow me on Twitter. Link in the description and the bio. It should be in there. What did we get today? We had Kathy Wood just registered for an Ethereum ETF. ARK, 21 shares Ethereum ETF. Blah, blah, blah. Who knows? There's probably going to be more to come. So at some point, the wall of money is coming into crypto. The question is, where are you positioned, right? How are you going to be positioned? And it's going to be a strong cycle when it does come. It might come not till next year, right? We still have the halvening next year. Liquidity is a big, it does move on liquidity. If the ISM turns up, that's going to be positive. But when investors want to take risk, this is going to be, the biggest driver of that risk, is going back into crypto, as it did the last cycle. Nothing outperformed Bitcoin and Ethereum over 100 billion. Not Apple, not Amazon. Tesla came very close to it, but nothing outperformed Bitcoin and Ethereum when it came to that. So a lot of liquidity probably headed for that market. So let's get back to the technicals there. Coin and Riot. So that's my question. That's my thing on Coin and Riot. I think that's just kind of what we're going to see. Let's see. Hey, thanks, Cavity Podcast. Thanks for the sub. Appreciate you guys. I do appreciate you guys. Appreciate it for the likes. And if you are on YouTube, or just jump over there if you guys want to help me out. If you enjoy my content, think I bring enough value, jump on the YouTube, subscribe, smash the likes, give me some support. I'd appreciate it. It helped me out. and I just want to bring you guys the best I possibly can. Do you cover all these analysis types and structures in your one-on-one? I want to sign up too. Yes, one-on-one. If you go, yeah, if you do the one-on-one, I will. The one-on-one, it's basically I'm gonna cover. Yeah, I'm gonna do all this stuff one-on-one. This is more macro though, right? So everyone's situation is different. The way they look at the market, the way they trade, what platforms they're using, their position sizing, everything is going to be a little different, which is why the one-on-one is more privy to me, kind of going through your situation. It's not financial advice. I'm not a financial advisor, but how I would think through it, right? Being in the market, my experience, and just give you the best analysis I possibly can when it comes to your situation. So that's how the one-on-one would work. If you're interested, there is the one-on-one sign up on my TikTok, the bio. You can it'll go to the website and you sign up there. And if the time doesn't work out for you, just email me or send a comment, say, hey, can I get a different time? And I'll definitely move that time for you if you want to do that one-on-one for sure. Become more knowledgeable in the markets outside of trading options. Yeah, 100%. We'll talk about whatever you want. Just sign up in there. I'll go check it out. I'll go check the calendar today to see if anybody signed up. Always go check the calendar to see if anybody signed up. Nvidia, okay. All right, so Nvidia here. Nvidia looks like it is starting to form a little wedge here. Okay. A little upside wedge. I mean, Nvidia is a tough one. It's not the best setup. I'll tell you what, AMD has a better setup. If you're looking at Nvidia as a day trade, I mean, the day's kind of over. Typically, what I would say is like this is Nvidia's price action. It's really tough. Nvidia's it's not it's moving kind of crazy. I think it's overextended in my view, to be honest. I think it's a little overextended. You want this RSI to really come down. I said last time, once the RSI comes down far enough, you could take a 6-month option out as long as the overall market is still finding support. Nvidia is going higher, right? So it came up, it's making a higher low in the RSI. When this RSI comes down again, but the overall market bounces, we want to see S&P hold 444. You want to see the Qs hold 373. That's your signal. Okay, let's look 3 months out, 6 months out, 12 months out, because this is my view. Day trading is hard. It is tough, but if you could swing trade, if you learn how to swing trade or at least get used to it, then that's less pressure, right? And you got to know where your stop is always. Where's your stop out? How do you stop out? Is it just you stop out? Do you want to see the over? And that's what I do in the one-on-one is basically tell you how I would do it, how I look at it, and that's there for you if you want to sign up. 480 is the support, so it needs to get back above 480. But like I said, AMD, if you're looking at this, AMD setup is insane. This is a gigantic, and the RSI is also pretty suppressed there. This is a huge flag pattern. This thing will go to about 150 when it breaks out, right? When it breaks out, AMD is probably going to 150. I mean, how long has this thing been wedging here or flag? You call it a flag, wedge, whatever. It's been flagging for 3 months. This is insane price action. I remember AMD when it was at $9. I got scared. I bought it, sold it at 10. I was like, oh, I made $1 on it. Went up to 100. I was like, wow. So point being, if you're doing options, it's going to be way different than holding shares, but AMD is getting primed for a large breakout in my view. All right. So yeah, it looks like that's what we got. Now, what I'm looking at here, this is free, right? Free analysis. I'm looking at Zoom. Okay. If you know, I'm looking at Zoom. I think big tech's going to outperform here. And Zoom is a big tech, not exactly mega cap tech, but it does have the resources to thrive in an environment. Look around. What are people using to communicate? They're still using Zoom. They're still using Zoom. And Zoom is not connected to Google. So the thing too, if you're using Google Meets, a lot of companies competing with Google don't want to use Google's information, right? They'd rather use Zoom's information because Zoom is not competing with them. Zoom is a one-off. So they're not competing with a lot of these big corporations who don't really want their data, their invoices to be on the company they're competing with, right? Whoever it is. So I think that's going to be a psychological thing for when it comes to Zoom. They had a very good earnings report and they have a good balance sheet. And I'm going to actually go over this in the coming weeks. Usually on Mondays, I went over, if you want to check out the video on Tesla, the top catalysts for Tesla to go to all-time highs this year on my YouTube, 420. You go on my YouTube. I came out. It was on Monday, but those are the top catalysts for Tesla, right? Forget the price action. Once you get FOMO in Tesla, when the overall market holds, which I think it is going to hold here, we're still in the uptrend. Everything looks solid. There's no credit risk. VIX is at lows, right? Yes, the dollar's breaking out. Yes, inflation went up, but I think investors are ready to put on risk here because there is no recession, because inflation is coming down in certain areas and the economy is not falling apart. And psychologically, people want to be positioned. They don't want to miss out. So I think that's coming. And earnings are being revised up. That's another one. Earnings are getting revised higher. Wow. Why? Well, GDP first got revised higher because they needed to. Then earnings get revised higher. The difference between GDP and earnings is GDP can go lower and earnings can still stay high for certain companies because they can retain those earnings. They're basically taking market share from where consumers spend in one area, they stop spending and they still keep spending in one area. Maybe they spend even more. So that's where I think big tech is headed here going forward. And B2B is just very extremely strong. So we're looking for Zoom. It's breaking out of this descending channel. So this is a technical breakout on the daily chart, which is very important. Not only is it breaking the trend, the downtrend, but it's also starting to lift. Now it's not there yet. It's getting close above this. I want to call it, you could make this the high 75 to 76. I mean, there's a lot of ways there's no perfect TA. There's not a perfect analysis, but I want to call it a whole number at 75. Once we hold 75, which we had a big capitulation yesterday, right? Big upside, came back down, a lot of supply there. And then guess what? It pushed higher today. So it's closing higher. Second day play is what you call this if you're swing trading it on a short term. This is a second day play, because on the second day, it starts to break out, right? Well, it's not exactly a second day play because it hasn't broken the highs from the previous day, but you could just go to the support area and find that. But that's more technical trading on the short term. I'm looking much further out. I'm looking a year out. Okay. I'm looking past the Fed cutting rates. I'm buying contracts way far out to see how this plays out. Very suppressed level. So that's my commentary there. Let's see. What else do we have here? I mean, I have a lot to say about Chainlink as a crypto. If you guys are new to crypto, I can splash you with that if you're interested. Only if you're interested. We talk about it pretty much every day. But this is probably, I think, the best opportunity in crypto. We're talking big, large return. You're taking risk. You're taking the safest risks because the fundamentals back it, because the macro backs it, because the central banks back it, right? That's what's happening with Chainlink. And I wrote an article about it if you want to go to the website and check it out. I actually am changing the name to Tokenize Everything. It was called the most underrated crypto. But the real narrative is if you're going to token the world, it's inevitable for the world to be tokenized. It is inevitable. All assets on the planet will be tokenized at some point. That market is 800 trillion for tokenization, and Chainlink is the number one protocol for that to actually happen. Nobody's going to go build a blockchain that does what Chainlink does. They cannot do it, which is why they're outsourcing it to their operator, to their Swift system, to CCIP, cross-chain interoperability. Bridges, you probably never heard of them. Bridges / interoperability is the next bull market. That's what it's going to be about, interoperability. And by far, they have the largest monopoly when it comes to that. Every DeFi network uses it for price feeds to connect the public blockchains to private blockchains. But if you want to read up on it, just go check it out. It's at the website. It's just type in Chainlink or type in tokenization. It'll be on there if you want to read about it. If you want to learn more one-on-one, we can do that. Eventually I'll do a podcast on it. Just got to find the time to do that. So that's the TA there. What are some other technologies we're looking at here? Amazon looks primed to move out. I really want to finish off with the S&P because everything comes down to the macro and the S&P 500 here. Oh, market internals. Let's check the market internals. This is what I forgot to look at. I'm going to turn on TOS. Hopefully, I think Twitter takes up a lot of room on my laptop, even though I got the M1 chip. I'm going to take off my Twitter. I don't think there's nothing new there. I'll present it tomorrow if I need to. And I'm going to send out this Beige Book if you guys are interested. Sign up. Newsletter is free. Link in the description in the bio. I'll send out the Beige Book. I'm going to send out the Tesla top 10, the top catalyst for Tesla this year. And you'll get that in an email. You just sign up, check your email, make sure you verify it. And I'll send out the Beige Book if you're interested in the macro. And we're going to switch over to, as soon as this loads up, I'm going to switch over to the Thinkorswim charts. I like to use Thinkorswim to actually trade. TradingView is really good at navigating all the markets really quickly. The charts move around. But if I'm really looking at micro levels and also there's some other stuff you could do on trading on TOS that you can't do on TradingView. So this thing is loading up. I'm going to get on there. Hey, if you guys have questions, let me know. Throw me the questions. If you're confused about, if there's something you're like, oh, I'm scared to ask, there's no dumb questions. There's really no dumb questions. If you're wondering, should I buy this? Should I invest? Not should I invest, but like, is there a recession? I can give you my narrative or explain to you why I think we're headed for a recession or why we're not headed for a recession, and clear that up for you. Make it simple. There's no dumb questions. Just don't be afraid to ask questions, even if it's on a stock also. All right, so I'm gonna switch over to that. Got that ready. Here we go. So market internals here for you nerds, for you technical nerds. This is basically, well, forget what people say, what the market is doing. What is market breadth looking like? So this is the 50-day moving average, right? This is how many stocks in the S&P 500 are moving above the 50-day moving average, market breadth. Well, they're going higher or lower? We moved up, pulled back. This is not good. That doesn't look great. So a little weakness there. This is the 100. How many stocks are moving above the 100 or what percent? And we have 50% are moving above the 100. We're still in risk. I want to say you could call it risk off mode, but like not a trend yet. We're still consolidating here. So 50% on the 200, 50% on the 100, and then 35. What is this? 35%? Yeah, about 35% above their 50 daily moving average. What about that vol Q? Why isn't it on here? Vol Q, which is the volume, breadth of volume. I guess it's, oh, there it is. All right, let's see what this looked like today. Oh, is this advanced decline for volume? Maybe that's advanced decline. Talk about advanced decline. Oh, this is interesting. So today, just looking at today's price action for, oh, no. Why can't I make that? I'll just do it right here. Advanced decline is how many stocks are advancing versus declining. And I wanted to take a look at the signal we got today, which is that after the Beige Book came out, which is we went over the Fed, what the Fed's looking like. That's exactly about when the market bounced. So the market's responding good to what the Fed is seeing going forward. It is actually responding positive. That's a good sign. And we're just pulling into recheck the 444 level. So that's what I see there. I don't think we have any other questions. Missing anything? We went through a lot of information. Anything on Wall Street? Let me see. Wall Street Fed Collins policies can proceed cautiously in the future rate hikes. Go with quality growth stocks. That's what 14 minutes. Go with quality growth stocks to weather tough markets, economy head, blah, 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 research. So I'll finish with this because this is sort of what I see coming here is high rates, higher inflation, right? Because of the oil prices going up, and we'll see how long that sticks. It's going to come down to the big tech companies, big technology companies, or it doesn't have to be tech, but usually it is. How is Apple looking? Apple sold off. Wow, Apple sold off hard today. Look at that daily chart on Apple. And look at the moving averages. Actually, let's take the gaps off. Let's see what these things are doing. Try to fill the gap, couldn't do it. Still think Tesla is the um, most powerful catalyst going forward, especially because their energy storage business is the biggest in the world for supplying batteries that store energy. And what is the crisis we have? We're in an energy crisis, right? Inflation coming from oil prices way too high. Uh, Tesla looks like it's starting a wedge. You're getting a wedge here on Tesla. It's kind of a short-term wedge, but I'm looking at this. I was waiting for 241, never got there exactly. So we'll see. Um, Maybe I should have grabbed it, but it just didn't hit my price target. So that's what we're looking at there. So, what's a wedge? A wedge is it's a type of price action that basically reflects buyers and sellers fighting each other. It's like a rubber band. So you pull the more you pull the rubber band, like you're fighting on both sides, and the wedge kind of exemplifies that fight. You're making higher highs. I'm sorry, you're making lower highs and higher lows, which okay, that's more technical. But you basically the wedge gets to the point where the rubber band snaps, boom, you go one direction or another. Usually, if the trend leading up to the wedge is from the lows, it's a bullish wedge pattern. If it's coming from the highs, which is, if I believe, if I look right, is it Disney coming from the highs? Right now we're seeing Disney, that's very bearish. I think Disney is showing a bear wedge or a bear flag. Yeah, it is. Look at that. That's a bear flag. Well, you could call this a wedge too, but or a flat triangle, whatever. This is also a wedge. You see higher lows, right? Higher low, higher low, higher low. I'm sorry, lower highs, lower highs, lower highs, lower highs, and then you get this but this one's more flat, so more downside pressure, and it broke. It finally broke, and I said, "Hey, this doesn't look good." It got below that level, and it kept sinking. So Disney looks like trash. Like goodness sake, how far can this go? And I know that's going to piss a lot of people off because they love Disney, and out of fault, it's like they love Disney, but hey, what you like to just because you like something doesn't mean it's a great company, right? Typically, we're in a transition period. It comes down to who can make the most money and who can survive. And a lot of the wokeness is hurting these, but you got support. I mean, Disney is not going to not recover. It just doesn't look good in the short term. Probably a good buy for the long haul. Maybe, I don't know. I don't want to get stuck in it though, because what if something systemically changes for Disney? But I don't know their business model that well, so I'm not going to talk too much about Disney. Also called the yo-yo, I do believe. Also called the yo-yo. Oh, okay, the yo-yo. Never heard of that. Makes sense. Tesla's in a just complete uptrend. Very strong uptrend, but I wanted to look at the daily so we could see the gaps to be filled here. Real strong support off 245. So just looking at that, I might have to actually, if I do end up adding, I don't know if I will. I'm still looking at these economic indicators. Economic, I got to start seeing economic because economic isn't very smooth. Um, and I've been struggling with saying that out loud. It used to piss me off. I'd be like, why can't I say economic? Um, Okay, here we go. Yeah, this gap is at 245. So we'll see. I still think it needs a little more consolidation. I want to see I want to see the overall market really support 244. I said that in the past. So I got to stick with my rules. If I'm trading something, is my rules are I want to see the S&P, SPY, hold the 244 area. It did that today. It did that today. We got 245 support. So the next question is, well, did I miss this? Did I miss it? Because it did come out and it did support 244. Well, what do we got looking forward? What's ahead on the macro that could change this? Because we know algos are responding to the macro economic data. See, I caught myself there. The macroeconomic data tomorrow is Thursday. And tomorrow we get we get unit labor costs. That's an inflationary non-farm productivity, initial jobless claims. I don't think none of this really moves. We get Fed speak. That's going to be big. Fed Harker speaks tomorrow. And guess what? One of the Fed members this morning said, "Oh, I think the data calls for another hike." So these fools piss me off because one of them says they call for no hikes, pause, and the other one says a hike. Who knows? None of them agree, but you don't really want them to agree anyway. We get gasoline production. We'll see how that turns out. Fed Bostic, Fed Williams, Fed Bowman. You got all Fed speak tomorrow. So the market will be moving, and this is in the evening time, off of the off the Fed speakers. I think that's going to be the biggest catalyst going into tomorrow is the Fed speakers are There's like 4 Fed speakers. They're going to be another one at 10 p.m., which is really late at night. If I see something come out, I always post on my Twitter too. So go follow the Twitter if you want to support. Let's see, Fed speak bar. So yeah, that's it tomorrow. And then you got Friday, where the biggest is, what do you got? Used car prices, consumer credit. There's not a lot of data this week. It's mostly Fed speak and technicals. I think the Fed will come off a little more dovish. I think they have no choice to come off dovish unless they cite oil, gasoline prices moving up. Then we might be in trouble. All right. So to the no, Jerome Powell doesn't speak. There's like 12 Fed members. So what Tesla is doing is called the falling wedge, correctly? Yes, Tesla looks like a falling wedge. Even the best right now, the best pattern I'm seeing in the whole market, which I haven't seen every single, I haven't seen every single technical indicator, but the best, and I'll put it up here on YouTube, the best pattern I'm seeing is that AMD pattern. That's a falling wedge right there. That's a falling wedge slash, you could call it a falling wedge or a flag, right? Or a flag pattern. I mean, same thing. It has the same type of fundamentals there. And AMD's looks really good. AMD's looks really good. It's not the tightest, but it is the longest consolidation I've seen for a while. This is a very, very long pattern. Maybe there's some other ones. I just haven't seen them yet. Oracle, let's see, TSM, Teladoc, AMD. I think that's it. Yeah, Netflix. I think Netflix just broke out of a big pattern. Yeah, well, Netflix was wedging. They just broke out. Which news sources do you use? I actually talked about this the other day. I use Twitter. Like, Twitter has a lot of good stuff, but I also use tradingeconomics.com. I use tradingeconomics.com. I use I'll look at CNBC. I will look at this thing called macro micro, because I track the macroeconomics, not really on Twitter. I track those on my own, but there's a lot of data out there. There's technical data, there's sentiment, positioning. I always look out for that, because there's not a whole, everybody has different data on sentiment and positioning. A lot of those things you got to pay a lot of services for. So I just look out for people on Twitter who push out sentiment positioning data. Whoever that is will do it for free. So sentiment, positioning, you have technical stuff, which I could do on my own, macroeconomics I could do on my own. You have Fed policy stuff, which today I found that on Twitter. I found the Beige Book on Twitter because, I mean, it's going to get posted really quickly. You just look for a Fed Beige Book, boom. So yeah, I use a lot of different sources, I guess. I'd have to go through it in my head, but there's a lot of stuff out there. Like I said, if you do one-on-one, I can pretty much give you all the information. Is Jerome Powell speaking? No, he is not. No, he is not. So that's kind of what we got. Now, for this article, where is it? Put S&P back on. Okay, S&P holding that important level there. Close the gap. I think it's going to struggle here. I think we're going back to retest 444. We'll probably retest it as these Fed speakers speak. So here we go. This is the article. This is an article from, who is this? I mean, nobody cares. It's called "Go with the Quality Growth Stocks." I think. Let's see what they flag in here. Oh, here we go. They just straight up show them. We'll look at I'll throw them on the charts. Okay, cool. Let me read it a little bit. So, in an economic downturn, select quality growth stocks could help investors withstand a market pullback, according to Adam Parker, founder of Treverity Research, whatever. Parker anticipates rapidly growing businesses will outperform as the economy slows down. That's right, because they're going to take market share. With this in mind, he identified a list of quality growth stocks that can remain resilient and provide a growth even in tumultuous times. Adjusting for the S&P 500 performance, only the highest quality quartile of growth has cumulatively generated alpha over the past 25 years. So this is between mega, large caps, blah, blah, blah. Let's just get to them. I don't need to read no more, I don't think. Okay. So they have on here Acom Technologies, Acom. I don't know who this is. Acom Technologies. Some tech company. Starting to recover. I don't know what they do. Okay. That's the chart, AKAM. I don't even know what they do. He has MP. This is probably his book. He's pushing his book. MPWR. Never heard of him. Monolithic monolithic power systems. Something with energy, possibly. Hasn't broke out to all-time highs yet. Charles Schwab. Oh man, I would never get Charles Schwab. Charles Schwab. Yeah, he's speaking his book. What the heck do you want to? Nobody wants to invest in Charles Schwab. It looks like KRE. Looks like the banking system. The regional banks. AVAV. So many stocks on the market. This thing just bounced pretty hard or moved up, but I don't know if it's worth it. I don't know what they do. I'm gonna stay away. Apple. Okay, we all know Apple. I'd say this is a good pick just from my knowledge. Ooh, Apple's really consolidating at the highs too. Like I see a wedge start that might be formed on Apple, and this is much needed. It went up a lot. Went up a lot really quick right here. So you get this flat wedge. You could call it a flat wedge that is forming. It consolidates and then boom, breaks out of that level. So we'll be take a look at that level. This one, I don't know if we need that anymore. I don't think so. It looks like we're just wedging. Netflix. We just went over Netflix. Netflix is breaking out a little bit. Netflix is hard, but when it moves, it moves. This is sort of a dragon wedge. You get the neckline, and then you get the wedge, and then boom, breaks out. Now, NOW. Lee was talking about this company. Wait. Oh, I thought they were already at all-time highs. Huh. Maybe I'm thinking about a different company. Man, the options must be crazy in this one. Especially they have low options. And then you have Microsoft. Okay, cool. Moving off the previous support, but it does have, yeah, it's moving in the zone. We'll see. Not a whole lot of stuff going on. I just want to look at the cues in the overall market, see who's outperforming who. It's a head and shoulder as well. The shoulder is higher than the last shoulder, and it's holding the previous support. We'll see if the cues hold 372. We'll see if S&P can hold 444. Those are the big levels going into tomorrow. Can you hold those levels? That's all I got for you guys. Appreciate you. Subscribe to the newsletter. It is free. If you don't mind, sub to the channel, to the YouTube channel. I'll be on again tomorrow. I don't think we have anything special. So same time, 2:45 Eastern time. And other than that, you guys get your exercise, stay healthy, stay blessed. And yeah, stay blessed. We'll catch you guys tomorrow. Thanks for joining. Appreciate it.